Well, welcome to Beers with Rich. I'm Rich, editor of Under the Radar Report. We live in crazy times. What do crazy times deserve? A crazy beer, as well as some explanation of why the times are crazy. Look, let's look at it. What's this crazy beer? It comes straight from a subscriber, a generous subscriber. Terminal Velocity by Tallboy and Moose. I think it comes from Preston, Victoria. Well, Kvik IPA, which I understand is something to do with Vikings. Let's crack it. Whoa. It's the sound we love. Oh, I feel very Scandinavian, although in a Victorian sense. It's not bad, a bit malty. Actually, I could enjoy a couple. Let's make another toast. Toast, it's not just a cliche, people. One of our tips, the accounting software specialist, reckon, sold a division, the stock up almost 50% on Thursday. The accounting practice to be sold for 100 million. What's not like about that? More than 50% of the business still remains. Investors see value and they're buying it. Another one this week, Infomedia, getting taken over, up 30%. And then as our recent tip, the Forex payments company, OFX, it's up 10% since we tipped it just a month ago. Look, these gains can't be overlooked in such a difficult market. I mean, what's going on with the market? I've got two words. Inflation and fear. Let's put the beer down. It's time to get serious. High growth names have never been more vulnerable. The three biggest retailers in the world, the big guns of the US, Target, Amazon, Walmart, all dusted up to 25% in the past few weeks. That's more than the capitalization of most markets. The entire capitalization. I mean, we're talking huge falls, huge amounts of money going through the markets. I mean, what's happening? Well, inflations are eating their margins, eating away at the very core of these growth targets. Basically, let's look at it, because they all have stuff in common. A, they all overestimated the demand, so they were top heavy with inventory. B, face rising operating costs. C, inflation eating away at their margins. C, they serve a consumer who's being hit by higher mortgage and gas prices. Look, much of this is true for Australia too. I mean, look at Bunnings owner Wesfarmers. They've been hit. There's rapid margin compression that exceeded, I guess, investor expectations, so it came as a surprise. On top of this, we're seeing China's economy, go into a lower growth phase as these zero COVID policy really hits home and affects their economy. We're seeing segments of the market hit much more than others, like the retailers, stocks where there's huge amounts of growth embedded, like technology most notably. These are called long duration, which basically means they're not making much, if any, money anytime soon. So what do? You look for value. So that's what we did this week. This week's reports are particularly good. We talk about a lithium stock in the small caps. We talk about a manufacturer in the small caps. These companies, like the lithium company, the new stock that we're covering, about to go into production, there is huge demand for their product. That's a big deal. The price is going up. So all this, uncertainty around, well, there's less uncertainty when it comes to the price that these guys are going to be making for their lithium product. So it's a big deal. It could be like the next Allchem, which, if you'll remember, was the merger between Orocobre and Galaxy. So that's the small cap side. Lot to read about. We also cover OFX, which I just mentioned, which is exciting. In blue chips, we drill down on resources and financials. And I think the key thing to remember is, okay, there's some headwinds, but things aren't as bad as they seem. China is throwing a lot of money at pump priming the economy, at property, at infrastructure. So that's why we're seeing, some rallying of the steel production, which will translate to, a stronger for longer iron ore price, which I think will consolidate at current levels. So, we're also seeing, balance sheets that are strong, and that's in the banks. So we're seeing strong balance sheets, and we're seeing a bit of pressure on margins, but we're seeing companies that can weather the storm. So what we're talking about when you're getting these kind of sell-offs is quality on sale, and that's what you've got to look for. You've got to look for quality companies, strong balance sheets, strong cash flow, or foreseeable break-even dates. So stuff that you can see, have a line of sight on. Because if you don't have if it's often the never, people are just going to sell. So with that in mind, I've got 3 stocks that are on the speculative side. They're small caps on the speculative side. I've mentioned a couple before, but they've been hit rather hard, and they're getting hit hard. But what I like about them is their last quarterlies. So their most recent quarterlies show that their cash flows are improving, and that they're either breaking even or they're soon to be breaking even. Playside Studios, I've mentioned Playside Studios a couple of times. Like, this is a stock that's a good hedge on your kids' gaming addiction. These guys make make games in mobile and in PC, and they're really well regarded. They've got big contracts. It's a fickle game, but they've got a big pipeline. Most importantly, their third quarter result shows they're on track to breaking even. This is a big deal for a little company. Another one that's high risk, Airtasker, jobs marketplace, sort of digital marketplace provider. So all the metrics in the last quarter were positive, and that's a big deal. Their third quarter result was particularly good because it provided evidence of strengthening cash flow. Beamtree, a stock you probably haven't heard of, e-health specialist. This one takes a bit of time to get an understanding of what they do, but basically they're in the hospital servicing business, and they've got a huge footprint around the world, in particular in the US and in the Middle East. So these guys have been having a tough time, but a new $7 million contract saw a steep increase in the share price, and most importantly, it shows that they're break even. So, and that they're going to, come somewhere close to their 50 million revenue target over the next few years. So these are stocks, okay, don't put your house on them, but, like all these stocks in an uncertain market, buy small parcels and step away. So reduce your risk by not trying to gamble too much or invest too much at any one time. And that way you'll be spreading out, you'll be spreading out your risk. So, and especially with quality companies, because these companies, the market goes up and the market goes down, but these are companies you're going to have confidence are going to be around not just tomorrow, not just next year, but in 10 years' time. Or, in the case of small caps, they get taken over. So what's next? Well, obviously a sip of beer. Obviously. It's not bad, actually. Thank you to the subscriber. Terminal velocity. I'm not sure what that means, but it could be terminal if you had too many. We're continuing our lithium series. We've got a review on the aged care community modular home sector, so that's really interesting because I think we've got some upgrades there. And we have a new stock. Lots to look forward to on Beers with Rich. Lots to look forward to in life. Here's to next week. Cheers.